All right, so I'm looking for property. I call you. When we meet, what do I need to have to be able to start the process?
Right. So, one of the cool things that I like to do with our clients is make it a conversation. Okay. It's not an interrogation, right? There's a lot of different banks out there, and my job is to make this as comfortable and as smooth of a process for you. But there's really three things that we're going to hammer on. Okay. So the first is what we call your loan to value. It's basically how much the purchase price of your home is going to be compared to how much you want to put down. Okay, so we talk about FHA, that's 3.5% down. Conventional starts at 5%. Sometimes we can go down to 3%, but typically it's going to be 5%. VA and USDA allow you to do 100% financing, but there's special qualifications. USDA we spoke about, you have to be in a specific area. VA, you have to be a veteran.
So 100% financing means no money down?
Yes, no money down, but and we'll talk about some other stuff later, but yeah, that's typically no money down. You can finance 100% of the purchase price of the property. Okay. But again, those are very property specific, or in the case of a VA loan, you have to be a veteran. Okay.
Okay.
So conventional is going to be 5% down. FHA will be 3.5% down. Okay. One thing I did want to note and bring up. I do have a lot of clients that call me that say, hey, are there any first-time homebuyer grants available?
Hey.
Okay, because the buzzword, right? Yeah.
Grants.
So, exactly.
Free money.
Exactly. So, and that's one of the things I think we should really hammer on. When you see, some of these grant programs that are out there, okay, there are some really, really good ones, and there are some that aren't so good. In life, nothing's free, right? There's always going to be trade-offs, especially in banking, okay?
If you see something that's free, it usually costs a lot.
Yeah, exactly.
And
so just like if you see a home that's that's in a 200,000 price point neighborhood and it's listed at 150, there's probably something going on, right?
Yeah.
So something your eyes should always obviously perk up, and we want to, if there's money out there for you, we want to go get it for you. But there's almost always strings attached to it. Okay, one of the biggest ones with grant programs is they want to make sure that you're going to stay in the home for a longer than normal period. Okay, OFA, Ohio Housing Finance Agency, is an amazing program, and they help out a ton of families. But I always want to make sure let my clients know that, hey, that grant program, the money that they gave you, okay, you have to stay in the home for 5 years, okay, or longer. Otherwise, you're going to pay a prorated portion of that money back. Okay.
Even with the 4-family?
With any of their options, there's always going to be a period that you have to stay in the home. Otherwise, if you sell it, it's called a recapture. They're going to recapture that money that they gave you because you didn't stay in the home as long as what the terms were for.
You breached the contract.
Exactly. Yep. So we want to make sure, because I've moved a ton in 5 years. Okay, and who knows where I'm going to be 5 years from now, right? So with some people, it's a great opportunity to help reduce the amount that they have to put down. But we want to make sure that all of our clients are aware of that, because that's super important. Another thing with the grant programs, they're always going to charge additional closing costs when it comes to that. Okay, so they may be giving you 3%, okay, of the 3.5% you put down, but if they're going to charge you $500 for this and $150 for that and $75 for this, then you have to take that off of there, okay? And by the time it's all said and done, it may have made more sense for you to just put your own money down at that point, okay? So, moral story, it's not a down thing, but I want to make sure that everybody's aware of of the strings that are attached to that money. If it's still a great option, let's push forward with it. If it's not, then we'll look at some other alternatives.
But you recommend an FHA for a new buyer?
I don't recommend any program. Okay, my job is to show you which ones are available. Okay, and the pros and cons of each one.
Yeah.
We spoke a lot about FHA. Conventional 3% down for first-time home buyers is typically going to be a better option if your credit score is higher. Okay, the reason being, we talked about that FHA mortgage insurance, right? So that FHA mortgage insurance is very middle of the road. Okay, so if you have let's just call it a 675 credit score. If your credit score is 675 or less, your mortgage insurance on FHA is probably going to be better. If your credit score is over 675 and you can do 3% down conventional, then your payment's going to be less because your mortgage insurance is going to be less than what it would be on the FHA route. Okay, and it's really easy for me to show clients both options, and then you can kind of make the decision one way or the other.
Yeah.
Okay, FHA is a little bit more stable. Conventional, if you're well qualified, is going to probably be a better route to go or the cheaper route to go. Okay. One thing to note that if you want to buy a multifamily, and you're going to live there, so duplex, triplex, or 4-family, FHA is going to be the only route that's going to allow you to buy with 3.5% down. On a conventional side, they're going to require more money down.
What and it's like a set formula on the conventional side, like
it's a guideline. Yep. Okay. So FHA 3.5% down. Conventional, if you're buying a single family, is going to be 5% or 3% down if you're a first-time home buyer. And then if you're looking to buy a multifamily, it's going to be 20 to 25% depending on how many units. So substantial difference. If you're looking at buying a $250,000 home, 3.5% down on FHA, that's going to be way less than 25% down on the conventional route.
But then your principal and your mortgage is probably less though, right?
Yeah, because you're financing less.
Yeah.
Okay, so if we use let's just use a $200,000 duplex on an FHA versus conventional. So $200,000, you're looking at $7,000 down on the FHA route, whereas the conventional route, it's going to be 25% down, so you're looking at $50,000 down. Okay, yeah. So I mean, it makes a huge difference. You're financing less on the conventional side because you put less money down, but you got to add the $50K, right? If you don't have the $50K,
but if you got the $50K, that's definitely it's a better route, kind of, because
it could be, yeah, depending on what your long-term goals are. Yeah. If you're going to live there for 5 years, or 6 years, and you want to try to pay it off, yeah, let's go conventional. But if your goal is to live there for a year or so, this is your first property that you're looking to buy, FHA is great because now you can use that other $43,000 to maybe buy another property, okay? Maybe buy another duplex or triplex down the road. The biggest thing that we don't want to happen is we don't want our clients to be what's called house poor. House poor is where you spend every dollar to get in the home, and you have no money to furnish it, no money if something goes wrong, you gotta fix something. I would much rather see, hey, put down a little bit less, keep money in the bank, and then you have that nest egg in case something goes wrong. With COVID, I mean, there's a lot of people that their incomes and jobs are affected. Having that a little bit of money saved and set aside for a rainy day, goes a long way.
It's been a rainy, 10 months?
Right. Yes, it has been. I think what's really cool though is how resilient our housing market is right now. Whereas some housing markets have went down. Seeing a run on foreclosures and short sales and some of those negative events. Our market just continues to increase, month after month, and that's really cool to see.
Is it any other ways that people can find money for those down payments?
So down payment come from a lot of different sources. Okay, checking and savings, money that you saved up. Your 401k. A lot of people don't realize that you can take money out of your 401k to purchase a home as long as you're buying it as a primary residence. Your tax penalty is pretty low. It's called a hardship withdrawal.
Yeah.
Okay. A gift. So a gift would be mom, dad, brother, sister, friend, somebody like that. Give you, they can give you the down payment. That absolutely works. What doesn't work? Credit card advances and unsecured personal loans. Okay. So those are no-goes. You can't do that. You can't take your Discover card and do a
maxing out.
Yeah, exactly. That doesn't work, unfortunately.
So hit y'all moms and dads up, man, so they can go ahead and tell you, hell nah.
Right.
That's crazy, man.